Hello everyone. Wish you all a very happy new year. Hope 2022 brings good health for each and every one of you. In today's conversation, we'll first take a stock of the asset performance in the year gone by, followed by a small discussion on Omicron and Indian economic activity. 2020 was the year when all categories of financial assets delivered positive returns. It was the year when both monetary and fiscal policy were ultra loose and liquidity was in abundance. 2021 saw continuation of easy liquidity conditions and also recovery in global demand. We could see significant demand supply gap in the commodity space, coupled with easy liquidity that helped commodities to deliver yet another year of outperformance last year. Within commodities, metals and energies delivered sharp returns, though we saw some decline in precious metals. Global equities also rallied in 2022, particularly the developed market space. In fact, FII flows into global equity last year was higher than last 25 years combined. Most of the money poured in the developed market within the EN space. China and India saw participation by the FIIs. Consequently, in fact, Indian equity was one of the outperformer in the equity space, and within Indian equity, small cap outperformed the large cap. When we look at sector-wise returns, IT, metal, and power were the sector outperformance. Coming to the currencies, dollar strengthened and consequently emerging market currencies depreciate. But again, over here, rupee was an outperformer and saw only a marginal depreciation of 1.7%. COVID was prevalent through the year, but with better medical know how and vaccine penetration, those emergency like monetary policy settings were no more required. And because of supply side disruptions, inflation soared high in many economies, particularly Latin America, Europe, and US. Consequently, some of these economies started to deliver rate hikes. Fed also commenced tapering in November and indicated its intention to lift off rates somewhere in the middle of 2022. Against this backdrop, fixed income as an asset class were underperformed. As we head into 2022, we are expecting the continuation of rate upcycle. Inflation is likely to correct because there could be vaccine penetration and there could be ironing out of these various supply side issues through the year, which could ease off some inflationary pressures. Though for next this year as well, inflation is likely to be slightly elevated than its pre-COVID trend. Growth will be on the mend. Though in China, we are seeing signs of growth softening, against which that will be perhaps one economy which see easy monetary conditions. For rest of the economies, we are most likely to see a further hike in rates. Against this, it is still some time away before we get positive into fixed income as an asset class. Though for equities and commodities, there are pockets which could still deliver a good return. Taking a stock of the COVID situation, COVID cases are rising globally. In fact, new cases are nearly double of their October lows. Most of the fresh cases right now are coming out of US, UK, and select other European economies. In India, the count is still contained, though it is on rise. While the current variants seem to be less fatal, the numbers are so large that it is hard to imagine that there will be no impact on supply chain in the short term. At the very least, it could discourage people from returning to the labor market, which could intensify shortages in many sectors. Coming to India, there is definitely a better vaccine penetration and medical infrastructure. and consequently, we do not expect the impact to be as severe as it was in the first and second wave. As a base case, we expect a limited economic impact. We over the last 7 to 10 days, we are seeing select states imposing certain lockdowns like conditions, which will push out the recovery for these contact intensive sectors in the very near term. But as we just discussed, we are expecting minimal economic impact. Coming to the Indian economic activity situation, economic activity improved in December. Up until now, Omicron had not impacted the mobility. Amongst all segment of demands, export of goods and services are strongest, leading to the strength in various industrial indicators and tax collections. Import volumes are also rising gradually. Despite the strength in external demand and inventory restocking, we are seeing only a meager near 3% growth in industrial output, and industrial production is lagging the order inflow, the momentum seen in order inflow. That can perhaps be explained by select supply side issues in select sectors. But given that the order momentum is strong, we continue to expect recovery in industrial output. Consumer income and sentiments is also on the mend, though job recovery is very gradual. Within the consumer pockets, urban sentiment and urban demand is doing relatively better than their rural counterpart. In the capex, government capex, particularly central government capex, is very strong. For heading into FY23, there could be strong tailwinds from the fact that interest rate is low. Corporates have seen 2 years of earnings recovery. They have deleveraged. Cost of borrowing is low, and corporate tax have been reduced. We are also seeing signs of pickup and improvement in capacity utilization. All these factors make us positive on the industrial capex cycle. In the real estate segment, we are seeing residential sales showing positive and encouraging signs. And hence, after expecting a near 10% growth in India's GDP in FY22, we expect some 8 to 9% growth in FY23 as well. Some of the risks to our growth expectation could be from a very high inflation, particularly commodity inflation, which could dead demand, any global shock, such as sharp slowdown in China, which impact other economies too, and thirdly, if COVID sees any other variant which is very virulent. These are some of the risks that we can see now for the overall growth outlook. Given that we are constructive on growth recovery, we are also positive on earnings dynamic. We expect earnings recovery to continue in FY23 as well. But most of these earnings recovery has already been factored in, and in fact, 2021 saw a sharp re-rating of Indian equity valuations. Liquidity conditions was perhaps at its best. FIIs, after investing quite robustly in 2020, 20, they continued to invest on a net basis. They were a positive investor in 2021. Domestic institutional investors and retail participation was also very strong. It is slightly difficult to imagine that the liquidity will be as robust in 2022 also. Such a good liquidity absorbed a high supply of IPO in 2021. In 22 also, we have a strong IPO pipeline in the anvil. But from a very top down perspective, given that we expect moderation in liquidity, valuations are already stretched, and the fact that the earnings recovery is already being factored in, the top down narratives are not very exciting for the broader market rally. However, it will be the year of stock picking, and there will be pockets which can continue to deliver strong earnings growth and hence strong returns as well. Coming to the fixed income space, 2021 saw inch up in Indian rates across tenors and asset class. Eventually, as we head into the year, we expect repo rate to be lifted up by the second half of 2022. Inflation is likely to stay near the upper end of RBI's target band. The price hike momentum, which is being seen amongst the businesses, is pretty high, and that will pass on to the CPI inflation as well. 2021 saw an introduction of variable reverse repo rate auction as one of the monetary policy tool to combat the excess liquidity situation in the Indian banking system. Even as there has been rate inaction throughout last year, VRR quantum has been scaled up and it has driven the short term rates higher, particularly by the end of the last year. We are also seeing reduction in bond purchases by the RBI. RBI very recently, over the last 2 months, has been testing the water with some bit of OMO sales in the secondary market. And we also suspect some FX sales in the October to December quarter. But that is more because of the external conditions. Overall, it will be very difficult to wish away the excess liquidity in the Indian banking system until and unless some explicit measures are being taken. Government is likely to spend in the final quarter of this fiscal, which could keep the liquidity in the super excess. We will see 2022 union budget announcement next month. Market will be closely watching out for revised consolidation path in the union budget, any indication of MSS to absorb excess liquidity, and any changes in the taxation for FII investors to enable India's inclusion in the EM bond indices. As we work out our budget expectation for next fiscal year, it appears that a very sharp consolidation will be required by the central government were it to reduce the gross supply of dated securities and bring it lower than this year. It is highly likely that SDL supply would also be stay elevated in FY23. This is coming against a dynamic when gradually RBI's support to the bond market is reducing and we are seeing a pickup in the bank credit, which is only likely to improve in the next fiscal. That will reduce their appetite for the SLR securities. Of course, there could be some positive participation from the FIIs if we were to see India getting included in the EM bond indices. But on a very net basis, overall demand supply dynamics look stretched for FY23. Against this backdrop of an upcycle in the rates and tight demand supply conditions for the government bond, we are cautious on duration. That is all for this month. Signing off for now. Take care.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.